what's happening is that people are getting out of paper into physical. And I mean, when you've got, say, 100 times paper as you have physical or no physical, I mean, where do you go? And this is why you've got problems in the market. And they've only just begun, in my view. I think it's going to continue because unless the Chinese relent, and I don't think they are, bear in mind that they're now on the warpath. They turned around and told their own institutions yesterday or day before, don't buy US Treasuries, reduce your positions, get out of crypto. We're banning it completely. Anyone who deals in crypto is going to jail. So we're into a financial war. And the beneficiaries of this are going to be commodities as a whole, led by gold and silver.
There are moments in history when markets shift quietly, and then there are moments when the shift is deliberate, strategic, even confrontational. What Alistair Macleod is describing here is not just another cycle in gold and silver. He is outlining what he believes is the early stage of a financial war. According to Macleod, this is no longer about normal price discovery. It is about capital fleeing paper promises and moving into physical assets. When you have 100 claims on every ounce of metal that actually exists, something eventually breaks. And in his view, that break has already begun. But what makes this different, and far more serious, is the geopolitical layer. China is telling institutions to reduce exposure to US Treasuries, cracking down on crypto, restricting rare earth exports, and quietly shifting its posture towards silver just as the United States labeled it a critical mineral. These are not random policy moves, they are coordinated signals. Macleod argues that for decades, China allowed the US dollar system to weaken itself. Sanctions, reserve seizures, cutting Russia out of SWIFT, each move chipped away at global trust in the dollar. But last September, in his telling, China stopped watching and started acting. If this really is the opening stage of a financial war, one that begins with capital controls, spreads through bond markets, and ends with a scramble for real assets, then the pressure we're seeing in gold and silver may only be the first signal. In this video, Alasdair Macleod and Andrew Maguire break down how this tension is already surfacing inside the exchanges themselves, from Shanghai to London, and why the imbalance between paper contracts and physical metal could trigger something far larger than a routine correction. Stay with me through this analysis, and if you value straight, grounded breakdowns like this, make sure you like the video, subscribe to the channel, and share your thoughts below, especially if you're holding physical metal and watching these developments closely. Thanks, and let's dive right in.
Well, I mean, there's so many aspects of this, but so I'll try and boil it down to a few simple points. One point is that there was no speculative interest in COMEX or indeed in London ahead of this. What subsequently transpired was there was speculative interest on the Shanghai Futures Exchange and quite a lot of that on the short tack. Not long. I mean, this guy was Bain something or other, Shilin or something, short of over 30,000 contracts. Yeah. And what's interesting is that next week is Chinese New Year, Year of the Horse. Markets are shut. Mr. Bain has been told you cannot sell anymore. So the only thing you can do is buy to close or deliver. I'm awaiting the squeeze. I think the squeeze could be quite dramatic at the Chinese end. Anyway, so we'll see what happens there. But the other point I'd like to make is that on this dip, I'm hearing from everywhere around the world that buyers for gold and silver were just queuing up to pick it up deep levels. Now, that's interesting because it tells us that the psychology behind the market now is immensely positive. People are beginning to understand why you should have gold and silver. And the people who are understanding are central banks, governments, let's say some of the super rich, wealthy Asian families. They're not all, the people who may be people with huge, great funds who are close to government and know what central bankers are thinking. And perhaps some old money, which understands the difference between money and credit. Not that many people do, but understand that it's credit going down in value rather than money going up. Because, that's the point. It's not a bull market for gold. It's a bear market for fiat currencies. So there's that. The other point I'd like to make is that the geopolitics are evolving really very rapidly. I mean, interestingly, China has always taken the view, why interfere with the dollar's demise when the Americans are basically making all the mistakes? So really, for the last, 3-4 decades, they've just sat back and let America make all the mistakes. Every time America comes out with something against China, whatever, it ends up, China doesn't get hurt, really, and the dollar gets undermined. People start losing confidence in the dollar. I mean, a good example was cutting Russia out of SWIFT and stealing Russia's central bank reserves. So, literally everything they have done has just backfired on them. And so the Chinese have done nothing until last September. Last September, they finally decided that it was time for them to act. You have a capricious president in President Trump. You can't trust a word he deals with. He changes his mind every minute. He's, 1 minute he's peacemonger wanting the Nobel Prize, another he's all for bombing the hell out of someone or other. I mean, this is unstable, if you like. And it really started with the Chinese saying, okay, rare earths, you're not having them. And literally just stopping the export of rare earths without without an import, an exporter and a foreign country having a very, very good reason to do so, and being relatively friendly to the Chinese. I think what's really, if you join the dots, though, it was about the same time that things changed for silver, because until then, China had been happily supplying silver into the market, basically to suppress the price. But then they turned around and, America suddenly decided, this is a critical mineral. So China's attitude towards silver changed at that moment quite sharply. And I think various other things too. What we saw was suddenly there was a liquidity squeeze in London where I think it was October the 9th, you'll correct me if I'm wrong, lease rates shot up to nearly 40%.
Yeah.
Backwardations between London and COMEX appeared for a while. We've had consistently, you would think that this is just a problem confined to us in the West, but no. I mean, actually, the price of silver on the Shanghai Gold Exchange and also the Shanghai Futures Exchange has been higher by significant premiums over ours. So, I think this sort of tells us two things. First of all, the price is actually made in China, not here, which is very, very important. I think the second thing about it is that the supply situation in the West is still dire. And actually what's happening, if you get to the bottom of it, what's happening is that people are getting out of paper into physical. And I mean, when you've got, say, 100 times paper, if you have physical or no physical, I mean, where do you go? And this is why you've got problems in the market. And they've only just begun, in my view. I think it's going to continue because unless the Chinese relent, and I don't think they are, bear in mind that they're now on the warpath. They turned around and told their own institutions yesterday or day before, don't buy US Treasuries, reduce your positions, get out of crypto. We're banning it completely. Anyone who deals in crypto is going to jail, sort of thing. So they're clearing the text, in my view. This is classic, absolute classic. So we're into a financial war, and the beneficiaries of this are going to be commodities as a whole, led by gold and silver. And I think that broadly is roughly where we are, Andy.
Oh, that's really well put, and I think very succinct. And I think the PBOC, my understanding is the PBOC was very, very, very unhappy with this trader that we talked about a little while ago. Really unhappy because what China's been doing is creating the SGE is physically backed. So if I want to trade, buy or sell a bar on the SGE, I have to own that bar. And so essentially what they created is this very, very stable, as you say, the price really didn't come down a lot based on this huge drawdown. And if one looked at that and then you see, my understanding is, and I won't use the words that they told me, but they were very unhappy with with what happened.
Macleod points out that there was no major speculative frenzy in London or on COMEX ahead of this move. Instead, the pressure originated in Shanghai, where a large concentrated short position developed just as physical demand remained firm. And when that short seller was reportedly restricted from adding to the position, forced instead to buy back or deliver, the setup for a squeeze became obvious. At the same time, buyers around the world were stepping in on every dip. Not retail momentum traders, but central banks, wealthy Asian families, large funds with close ties to policymakers, entities that understand the difference between currency and money. In Macleod's words, this is not a bull market in gold. It is a bear market in fiat currency. Now the focus shifts. Andrew Maguire steps in to expand on what may have happened behind the scenes, particularly on the COMEX side, where options activity, potential spoofing, and regulatory scrutiny begin to add another layer to an already fragile market structure.
So I understand that this trader had other trades had written options positions on the COMEX, had related parties there. And from my understanding, and I do deal with the CFTC, is that the CFTC and their regulator is looking into who the hell. You remember in 2011, there was a sudden amount of puts, a massive amount of puts were put ahead, the day ahead. And what it did was immediately drew a trail to who that was. They were cancelled, obviously, because it was clearly someone who was involved in the whole situation. And although it's not of that scale, my understanding is, from what I hear, is that a huge amount of puts were put on the market the day before this happened. And so I think now the two regulators are going, now what you've done is impacted a regulated exchange in America. And now you've got the two regulators very unhappy. I understand that there's even talking about putting 100% margins, this sort of long only silver fund. It was the only fund that was silver fund, and it was long only. And I think they're talking about actually bringing margins up to almost to 100%. And I see that from the outside of the markets, they're also stepping up more higher and higher margins based on a percentage. But because they don't have the silver on this side and they do have the other on the other. So it's interesting dynamic.
I mean, what you're saying is that he was also running, if you like, call options or call positions on COMEX. So actually what he was doing is he was trying to arbitrage the spread between the two. Do I understand that right?
Well, I think he was. I think they bought a lot of puts.
What on COMEX? So
yeah.
In other words, he's doubled down on the short position.
Yeah, doubled down, knowing that it would, and then cancel them out.
What do you mean, spoofing it? In effect.
Yes, spoofing, 100% spoofed, and I think everyone. I'm not the only one to think there was massive spoofing going on. We had $5 spreads. I remember looking, I couldn't believe it, Alistair. Well, yes, we've seen $1 spreads in silver before, and it's no big deal. We've seen it in the past. $5 spreads between the bid and the ask on the COMEX. 10 cents it should be. $5 at one point. So clearly it was spoofer's heaven. And you could get away with an awful lot of stuff.
Well, that's interesting because the Shanghai Futures Exchange issued an announcement that they had identified, I think, something like 145 cases of spoofing and deal washing, I think they called it. I don't know quite what that is. Spoofing, we know. And they suspended quite a few accounts. Now, they didn't say in the announcement specifically what it was, but we assume it was with this big short, who was dealing through various accounts or acting in concert with others. Whichever way, there is this huge, huge short position to close. And guess what? The exchange is on holiday next week. It's shut. I mean, I wouldn't like to be in that position of having a position in a very volatile market, not being able to deal for a week. I mean, my goodness, I think that's negligent or stupid, really. So anyway, he's got himself into this position. It's going to be interesting to see how it comes out. But I mean, the point is, I think the main point is, and this is something that this guy obviously, doesn't really understand. What's driving silver is people are getting out of paper into physical. And when you have got, 1,000 tons of paper and only 1 ton of physical, you got a problem. So it's the last one to do it is a sissy, and this squeeze is only just starting. And it's not just silver, but I mean, if you look at all the metals, they are wildly undervalued, measured in gold. Now, you could argue, well, that's because gold has risen, and they haven't. But over the long term, the purchasing power of gold remains relatively constant. And I've worked on a basket of base metals, which is assembled by the IMF, and taking that as, if you like, the basis, I can see that the value of that basket is at only 20% of that long-term value, only 20%. In other words, that gap has got to close. Now, some of it could be gold going down a little bit, but in current circumstances, I think that would be a very brave call. What it does mean, and this is desperately important, it means that even in gold, these things like copper, silver, molybdenum, all these sort of, nickel, lead, whatever, a basket of them is going to go up 4 to 5 times in gold, while gold is rising against fiat currencies, which in turn means that the input, if you like, into producer prices is going to be dramatic in 2026 and even more dramatic perhaps in 2027. And it's not just restricted to, to a basket of metals. I mean, the whole of the commodity complex has been suppressed by the shenanigans, if you like, that go on in paper currencies, and particularly the dollar. That's being unwound. And I mean, energy prices, exactly the same thing. I mean, I can easily see oil shooting up, doubling, tripling. I mean, I'm not forecasting that, but, the dynamics behind it are precisely that. And it's going to be very surprising if inflation, that stupid phrase, which actually is loss of purchasing power of the currency, the fiat currency, it would be very surprising if that doesn't return in spades later on this year. And does anybody expect it? No. They're talking about, we'll get another cut in interest rates from the Fed. Isn't it wonderful? Come on. I mean, this is, the markets are broken. They are completely mispricing everything. And markets always get it right in the end. So, you may think, well, Mr. Market says this today, and therefore that's reliable. It will change. Markets will wake up, and then they'll be hell to pay. And that's really why, if you look at, if you want a reason why gold is maybe front running the dollar in terms of the dollar losing its purchasing power, that's the signal we're getting.
What unfolds in this second half is even more revealing. Maguire describes what appears to be coordinated put buying on COMEX just before the Shanghai short position triggered instability, large spreads, sudden volatility, orders placed and then cancelled, what many would call spoofing. And now, regulators on both sides are looking closely at what happened, but step back from the mechanics, and the bigger picture becomes clear. This is what happens when a market built on leverage collides with a shift toward physical delivery. When exchanges operate on fractional backing, and participants suddenly demand real metal instead of paper exposure, the strain exposes every weak link. Macleod then widens the lens even further. Silver is not isolated. Measured against gold, base metals are historically undervalued. By his estimate, trading at roughly 20% of their long-term purchasing power relationship. If that gap closes while gold continues rising against fiat currencies, the move in industrial commodities could be dramatic. And that feeds directly into producer prices, into energy, into inflation, or more accurately, into the loss of purchasing power of paper currencies. Markets today are pricing rate cuts and stability. Macleod argues they are mispricing structural change. In his framework, gold is not merely rising. It is front-running a repricing of currency risk itself. If this truly is the early phase of a financial war, one where major powers reduce exposure to U.S. debt, restrict strategic exports, and reposition into hard assets, then stocks, bonds, and crypto may all face headwinds. Commodities, led by gold and silver, may be the unintended beneficiaries. The key question is not whether volatility will increase. It is whether the paper system can absorb a sustained shift into physical demand without forcing a reset. And that is what makes this moment different. If you hold physical metal, I would genuinely like to hear your perspective. Are you seeing tighter availability where you are? Do you believe this is the beginning of a larger repricing between East and West? Let me know in the comments. If you found this breakdown useful, support the channel with a like and subscribe so you don't miss the next analysis. These shifts don't happen overnight, but when they do unfold, they move fast. Thanks for watching, and see you in the next one.